and welcome to the Wells Fargo Securities Monthly Economic Outlook. I'm your host, Mike Pugliese, and joining me today is Wells Fargo's senior economist, Tim Quinlan. So, Tim, last month we downwardly revised our forecast for economic growth on the back of the rise in COVID cases that we saw as the Delta variant emerged and how that was weighing on economic activity. But more recently, you've seen COVID cases decline in the United States, but we've once again downwardly revised our economic forecast in this month's update. What are some of the drivers behind that downward revision?
Yeah, hey Mike. There's the old expression, hope springs eternal. It apparently is also true that hopes can be dashed never endingly as well. So, whereas last month it was a function of, the Delta variant and increased cases, this month it's about the supply chain problems. Now, we've had supply chain problems since the stores were first picked clean back in March of 2020, but they've gotten a lot worse in recent weeks and months. And that's evident in a lot of different indicators, from the ISM index, which actually increased in September, but it increased because supplier deliveries rose. Factories are waiting longer for deliveries, and because prices are going up. Obviously, those aren't the kinds of things that you want driving the index higher. Beyond that, 8 out of 10 industries uniquely flagged supply chain constraints as some of the biggest problems confronting them in that report. Additionally, you've got this armada of container ships off the West Coast, and the backups there are contributing to other ports, even on the East Coast, where you're beginning to see backlogs. The port of Savannah, for example, has increased traffic coming to it, and they now have full container ships that are about 50% above their ordinary capacity, just waiting for truck drivers to come pick this stuff up. So this is having kind of a predictable effect on prices. And as prices rise, that of course has implications for Fed policy. So Mike, what is happening here in the context of inflation, and what does it mean at the Fed?
Yeah, so it's a great point, Tim. And when you think about the Fed's dual mandate, they've certainly met it on the inflation side of things, as you've just discussed. And when you look at it from a labor market standpoint, there's been plenty of progress on getting back to full employment, but has there been substantial further progress, which is the metric the Fed set at the end of 2020? We've recovered about 75 to 80% of the jobs we lost early in the pandemic. And that's probably enough to get the Fed to a point where wants to start removing some of its monetary policy accommodation. So you take inflation that's well above their 2% target, you take that substantial further progress on the employment side, and that probably means that the Fed will announce the tapering of its asset purchases at its upcoming November 3rd meeting. There's a chance that they'll announce it at the meeting after that in mid-December, particularly given that the September employment report was a little bit weaker than many people were expecting. But you have to remember that substantial further progress is cumulative. And so one report is not necessarily reflective of all of that progress that we've seen to date on both the labor market and the inflation side of things. And the second point to remember, of course, is that just because directionally they're starting to remove accommodation does not mean the policy is tight. There's still a tremendous amount of monetary policy support for the economy as the Fed funds rate remains near zero, and the taper will probably last until roughly the middle of 2022. It's probably around the middle of next year when those asset purchases have actually completely stopped. So you've got economic growth that's maybe being downwardly revised a little, but the Fed that should still be on track to remove some monetary policy accommodation in the not too distant future. But what are some upshots, Tim? Are there any reasons to be optimistic as we head into the end of the year on the economic growth outlook?
Yeah, I think there are a couple of things to feel good about, Mike. One is, this growth dent here is gone, but not lost entirely. So, for example, our full year growth number for next year goes from 4.5% down to 4%. But our forward looking numbers for 2023 go from 3% up to 3.2. So not enough to fully offset what was lost there, but to some extent these supply chain disruptions postpone growth that otherwise would have happened. It just now happens a little bit later. The other kind of cause for optimism is the fact that consumers are coming around a little bit. You talked at the outset of the call about how COVID cases have come down. The 7-day moving average has gone from north of 170,000 only about a month or so ago to fewer than 90,000 today. And what you've seen is consumers are increasingly comfortable kind of getting back out there. And that's evidence in everything from open table bookings for restaurant reservations to Google phone data showing people returning to retail and recreational locations in the office with greater frequency. And in a previous video, we talked about the outlook for holiday sales. So the increased momentum here on the consumer side, although the third quarter will likely be a soft one for consumer spending, it does bode well for holiday sales at the end of the year. So we began this with a discussion of supply chains. I'll kind of end it with one more comment marrying supply chains to holiday sales, and that is recent news that various retailers across the country, from Lowe's and Home Depot to Walmart and even Costco, are chartering their own cargo ships to bring over some of that needed inventory to make sure that their shelves are stocked when people come to do their holiday shopping. So with that, we'll say thanks for joining us today, and we hope you join us again next time.